What happens when a nation built on confidence suddenly loses it? When trust, the invisible glue that holds money, banks, and society together, disappears overnight. In 1907, America faced that nightmare. Banks locked their doors. People lined the streets demanding cash that no longer existed. And the richest man in the country, not the government, had to save the nation with his own fortune. This was the panic of 1907, the crisis that forced America to admit a terrifying truth. Without a central bank, the entire financial system could collapse at any moment. But how did it happen? How could the world's most ambitious economy, the land of Rockefeller, Carnegie, and Morgan, nearly destroy itself in a matter of weeks? And what secret deals, power struggles, and backroom rescues gave birth to the institution that still controls your money today, the Federal Reserve? Let's go back to the moment when America's economy stopped breathing. At the dawn of the 20th century, America was booming. The railroads connected coast to coast. Steel and oil empires transformed cities into giants of industry. Wall Street was a symbol of unstoppable growth. But behind the glittering wealth was a fragile truth. There was no central authority keeping the system stable. Every bank printed its own money. Every loan depended on local trust. And the supply of cash literally depended on how much gold sat in bank vaults. When business was good, banks lent freely. When times got tough, they pulled back, draining cash from the system as there was no safety net, no lender of last resort. If panic began in one city, it could sweep across the nation in days like a financial wildfire. And the last time something like that happened in the 1890s, it nearly toppled the government itself. But by 1907, everyone believed America was different now. Bigger, smarter, richer. They were wrong. The new century brought a wave of ambition and speculation. Trust companies, a new kind of financial institution, had begun to challenge old banks. They weren't as heavily regulated. They offered higher returns. And they used depositors' money to invest directly in risky ventures, especially the booming stock market. It was the Wild West of finance. And leading the charge was Charles T. Barney, president of the Knickerbocker Trust Company, one of New York's largest. Barney's empire was built on trust, literally. Tens of thousands of middle-class Americans had deposited their savings there. But behind the scenes, Barney and his associates were quietly backing a high-stakes scheme to corner the market on United Copper Company, a mining stock tied to powerful financiers, so if it worked, they'd make millions. If it failed, they'd ignite a chain reaction of panic that could destroy the entire banking system, and that's exactly what happened. October 1907, the scheme collapses. The price of United Copper falls from over $60 to less than $10 in days. Investors are ruined. Rumors spread that Knickerbocker Trust and its president Charles Barney were secretly involved. Fear spreads faster than truth. Depositors rush to withdraw their money. Lines form outside the Knickerbocker building on Fifth Avenue. People pound on the marble doors demanding their cash. But the vaults can't keep up in Arizona. Within hours, the trust runs out of money, and by the next morning, the Knickerbocker Trust, with $60 million in deposits, is forced to close. New York's financial heart stops beating. What began as one company's failure now threatened the entire nation, because in 1907, money was not digital, it was physical. When one major bank fell, fear spread instantly. Depositors everywhere began to withdraw cash, not because their bank was weak, but because they feared the next one might be. Money disappeared from circulation, businesses couldn't pay workers, and factories closed. Stock prices collapsed down 50% in a matter of weeks. Banks began hoarding gold and calling in loans. The system was eating itself alive. There was no Federal Reserve, no government rescue fund, no plan, just chaos. And then, out of the smoke, one man stepped forward. John Pierpont Morgan was 70 years old, a titan of finance, a man so powerful that his word could move markets. In October 1907, when the U.S. Treasury, the banks, and even the president were powerless, everyone turned to him. Morgan gathered New York's top bankers and trust company heads in his private library, a dark marble-walled room lit by flickering gas lamps. He locked the doors. "No one leaves," he said, "until we find a way to stop this panic." For 2 days, Morgan personally orchestrated rescue loans between rival banks, analyzed balance sheets, and decided almost single-handedly which institutions would live and which would die. When the city of New York itself ran out of cash to pay employees, Morgan's syndicate lent the money, preventing the government from defaulting. He ordered banks to pool reserves, convinced the U.S. Treasury to inject emergency gold, and stabilize the stock market with coordinated buying. The panic was contained barely, and for the first time, Americans realized their entire economy depended on one man's judgment. That man was not elected, he was not accountable, he was just the richest banker in the world. When the panic finally ended in December 1907, thousands of businesses were gone, bankruptcies soared, unemployment doubled, and public anger boiled over. And how people asked, can one man save or destroy the entire nation's economy? It was clear something had to change. that America needed a safety mechanism, a central reserve of money that could be released during crises. But there was a problem. Americans hated the idea of centralized financial power. They'd fought the very concept for decades. The last national bank, created in the early 1800s, had been shut down by President Andrew Jackson, who famously called it a den of vipers. So how do you convince a democracy terrified of bankers to create a system run by bankers? That was the puzzle of 1907. 2 years later, in 1909, Senator Nelson Aldrich, a Republican with close Wall Street ties, quietly gathered a group of the nation's top financiers and economists. The location, a private island off the coast of Georgia, Jekyll Island. There, under secrecy so tight that the men used fake names, they drafted the blueprint for what would become the Federal Reserve System. Their plan? A central institution that could lend money to banks during panics, control the supply of currency, and stabilize the economy without appearing to be controlled by the government or the banks. It was a delicate balance, part public, part private. And in 1913, after years of political debate, President Woodrow Wilson signed the Federal Reserve Act into law. America finally had a central bank. The Federal Reserve began operations in 1914, just months before World War I. For the first time, the United States could print money backed not by gold, but by confidence, the promise of stability. It could act as the lender of last resort. It could inject liquidity into banks when panic struck. It could, in theory, prevent another 1907. But with this power came something new, the ability to influence the economy itself. Interest rates, money supply, inflation, employment, all now tied to decisions made not by the people, but by a handful of unelected governors in Washington, D.C. The era of decentralized banking was over. America's financial system now had a heart and a heartbeat controlled by policy. The panic of 1907 didn't just create the Federal Reserve, it created a pattern, a warning, because every crisis since, from the Great Depression to 2008, has echoed the same story: too much risk, too little regulation, and a desperate scramble for liquidity when trust disappears. In 1929, when markets collapsed again, the young Federal Reserve froze, repeating the same mistakes it was built to prevent. In 2008, during the global financial crisis, the Fed had to play J.P. Morgan's role all over again, injecting trillions into banks to stop another collapse. It worked, but it reignited the same debate. How much power should one institution have over an entire nation's money? Today, the Federal Reserve's influence touches everything from the cost of your groceries to the price of your mortgage. A single interest rate decision can make markets rise or fall by billions. And while the tools have changed, quantitative easing, digital liquidity, global coordination, the underlying problem remains the same. Our financial system still runs on confidence. And confidence is fragile. We live in a world where one rumor, one tweet, or one bank run can echo the panic of 1907 in seconds. In 2023, when Silicon Valley Bank collapsed after depositors rushed to withdraw funds, history whispered again. It wasn't about copper mines this time, it was about startups and digital money. But the result was eerily familiar. So, fear, contagion, and the desperate hope that the system would hold. So what did 1907 really teach us? Lesson 1. Confidence is the currency. No matter how strong an economy seems, it's built on faith that money will hold its value, that banks will honor deposits, that tomorrow will be stable. When that faith breaks, everything else follows. Lesson 2. Power fills the vacuum. When government failed to act, private power stepped in. J.P. Morgan became the central bank by default. The Federal Reserve was born not out of ideology but necessity. Lesson 3. Every safeguard becomes a risk. The Fed was created to prevent panic, but its very existence can encourage risky behavior because people believe it will always step in to save them, and so the cycle continues. The panic of 1907 was not just a financial event, it was a mirror showing America the cost of its own ambition. It forced a nation obsessed with freedom to accept control. It replaced private trust with public policy. And it gave birth to a system that still shapes the global economy more than a century later. But even today, after bailouts, crises, and countless reforms, one haunting question remains: have we really made the system safer, or just built taller walls around the same fragile foundation? If you found this story powerful, share it. History doesn't just repeat, it rhymes. And the echoes of 1907 are still shaping the world we live in. Subscribe for more deep dives into the hidden forces that built and nearly broke the modern economy.